Yeah, everyone. Myself, Dr. Vinod, Assistant Professor, Department of Immunology, Head of Business and Ministry, Dr. Geography, in University, and good. So today I'm here to main the format of the account side for the folder, later screen. In final accounts, they have a two types, one is two types of accounts we are going to prepare. The final account, one is the trading like P&L account, another one is the balance sheet. So the main purpose of this preparing this final account, to know the position, whether in terms of really how much for gross profit or net profit from your business, and if you know the position of the financial position of the company, so proprietor. So in the final accounts, usually they have two accounts, one is trading account, clinical account, and another one is balance sheet. So I'm going to discuss about the format of trading account. So trading account, the first one, and the financial final account. So we are going to prepare the trading account. So trading account uh, is a account. The trading account for the year end, at the end of the financial year, with four columns, particulars, fields, particulars, fields, debit side, and credit side. So if trading accounts only record the only record whatever the production related expenditure like purchase, sales, so we are going to record the debit side only the expenditures we are going to record the credit side. So we are going to record whatever the credit and so the debit side, so the opening stock, it starts with billing. Opening stock. So whatever the opening stock in the beginning of the year, we are going to record. And second one, the purchase. So any purchase transaction in this year, we are going to record here. And if there is any purchase return, we are going to minus the purchase return. So ultimately, we are going to record the purchase. So direct expenses relating to the manufacturing, all the direct expenses we are going to record in the previous slide. So carriage, word of right to work, wages paid, top charges, employee, then the royalty charges, and import duty. Any direct expenses related to production, we are going to write in the credit side. And now, cost of goods sold, manufacturing, so we are going to record. In the credit side, only two things we are going to record. One is the sales. So how much sales we need to here? Less what are the sales returns from the sales and the report like sales. The closing stock. So closing stock, the end of the year, what is the closing stock? We are going to record. So after recording the screen, so we are going to confirm it. So we are going to make a total. We are going to make a total. After making a total, so the credit side is an income, the debit side is an expenditure. If we are getting more expenses, then it's a gross loss. The expenses are more compared to income, it's a gross loss. If the income is more compared to expenses, then it's a gross profit. After writing the trading account, so we are moving with the P&L, profit and loss account. So profit and loss account. So whatever the gross profit or gross loss we have account, so we are going to record into the P&L. First, we are going to record the gross profit or gross loss. If it is a gross loss, debit side, we are going to record the gross loss or because it's a loss. the expenditure, that is why we are recording here. And if it is a gross profit, it's a profit, that is why we are recording the credit side. In the P&L account, so whatever the in P&L account in the financial year, whatever the whatever the expenditure after manufacturing the product, like office and administrative expenses, selling and distribution expenses, and other expenses and losses, we are going to record it in the debit side. In the credit side, whatever the income we received, whatever the income we received, for example, then discount received, commission received, interest on loans, or any income we receive, everything we are going to write in the P&L account. So after writing the P&L account, so if expenses are more, then we are going to get loss. If income are more compared to expenses, then this net profit will be transferred into balance sheet in so we are going to add with the capital. The next is the balance sheet. So in the balance sheet, so the balance sheet as on 31st, the end of the academic year, with four columns, liabilities, fees, assets, and returns. All the liabilities we are recording in the liability side, whether it's a long term or short term. Lab assets, we are going to write all the fixed assets and current assets. Whether it's a long term or short term, we are going to record the assets side. So when it comes to asset side, so after investing the sole proprietor the capital, so we are going to look at how much we invested and in that year, how much net profit or net loss we are making from the P&L. If it is a net profit, we are going to add in the capital. Net loss, we are going to manage it. If there is any drawings, we go wrong by the sole proprietor, we have to do whatever the amount which are capital. And is there any reserve is creating from the profit? So we have to general reserves as well reserve. No reserve is created, so that any long-term loans is borrowed from the outside. So we are going to secured loans, unsecured loans, mortgage loans. Any loans is borrowed, so we are going to record current liability. So what within 1 year, how much liability the proprietor is having? So like land overdrafting to pay outstanding expenses and the short term banks, creditors, bills payable, all the things we are going to report. If there is any provisions we created, provision for employee benefits, provision for taxation, so we are going to if there is any provisions created from the proprietor. When it comes to asset side, so first we start with intangible assets. So what are the intangibles that your proprietor is having? If you build patents, copyrights, trademarks, and computers, if there is any, if there is any adjustment, so we are going to make the adjustment accordingly. Tangible assets. So tangible assets, if there is an adjustment like appreciation or depreciation, if any assets having a depreciation, we are going to minus the value. If there is an appreciation, we are going to add the value. If there is any investment made by the proprietor in some other legal instruments, or another company, so we are going to record. Current assets means within 1 year, so how much assets he is having that convert into cash. Any assets that convert into cash. Either maybe inventory or stock. Any advance is given, the collection from the debtors, bills receivables, any prepaid expenses, any accrued income we are going to issue, or how much cash we have. So all these comes under the current asset. And fictitious asset, there is at the time of creation of the sole proprietor, if there is any expenses made by the sole proprietor, so we are going to record in the P&L expenses. So after getting a total of assets and it should be equal to the if both are equals, then Whatever the capital invested by the proprietor and it's going to manage to the subside. It's going to invest it in the subside. Okay, I hope you will get the format of balance sheet.